Borrowing money is about to get more expensive. We told you yesterday that the Federal Reserve announced it's raising interest rates by half a percentage point. That is the biggest single jump in more than 2 decades.
So the big question is why? Well, it's to fight inflation. But let's bring Sarah Shookman in on this now to get us up to date with how all this works.
Yeah, did you guys know I minored in economics?
I did not know that.
I found that out today.
Yeah?
There's a lot to talk about then.
Yeah, I'm going to tap into it a little bit now. It was a while ago, but still. Today we saw a very rough day on Wall Street, the worst this year, over these concerns about the economy. So first, let's talk about what has happened. The Federal Reserve announced Wednesday it was raising what is called the federal fund rate by 0.5% or 50 basis points. Now that rate permeates through all kinds of other loans, making it generally more expensive to borrow money for a house, a car, or just your credit card. In fact, variable rates, like perhaps your credit card APR, is where you will notice this right away within a few billing cycles. And this increase was within the range that the Fed had warned, but at the low end. So some are now questioning whether it will do enough to slow inflation, guys.
Yeah, that is the big question right now. And by the way, Wall Street reacted incredibly negatively to what's going on right now.
Yes.
All the gains we had yesterday, which was our biggest jump in 2 years,
Right,
were more than eroded today. It was a terrible day. The question is, and here's where you can really tap into that economics minor.
Lucky.
How does the cost to borrow money impact inflation? In theory, it's supposed to bring it down, but how does that work?
Well, it all goes back to supply and demand, if you guys can remember this. Inflation is now 8.5%, and you're noticing it across the board, right? From utilities, groceries, and of course, gas. Well, that is influenced both by limited supply, think supply chain shortages, and increased demand. So the Fed is trying to control demand here to make it less desirable to finance a new house or a car. So for example, a $5,000 loan will now cost an additional $193 in total interest. So some people are going to say, no, I'm not going to buy that. I'm not going to do that. And the fewer people who buy, demand drops. Here's how Case Weatherhead economics professor Jonathan Ernest explained it to me.
So it relieves some of that pressure of everybody trying to buy those same limited amounts of goods at once. And that keeps prices down, but it also slows down the economy because we're not producing and buying as many things as we were when everybody was going out and really participating full force in the economy.
And that's the rub, and that might be what you saw on Wall Street today. The Fed is trying to do this slowly because instead everybody pulls back on spending and we hit a recession. Now, Fed Chair Jerome Powell says there's nothing to suggest that one is close, and he does expect more of these half-point increases in the coming months. And doing this gradually, hopefully that keeps the economy humming. But the reality is, as Dr. Ernest was telling me, this doesn't fix the supply issues, right? It doesn't address the supply chain, the war in Ukraine, natural gas, anything like that. So there is a bit of a wait and see here to see what the real impact both on inflation and the overall economy will be.
And some of these things just take time anyway. You know, it's not like a knee-jerk reaction all of a sudden has an instantaneous reaction. It is just, let's try this, and then it kind of lumbers along and we'll see what happens.
And as he said, the Fed sort of tries to put out these warnings so people know what to expect. So there's a little bit of an easing into it. And that's why yesterday we had such a great day because, hey, oh, great, we knew this was coming.
Yeah.
But there's likely to be more.
Yeah, well, he's intimated that there will be 6 rate hikes the rest of the year. Minus yesterday, that means 5 remaining.
5 more.
So Wall Street has sort of baked that into the equation, but the consumers are feeling it more and more every time. So we'll see.
That's
Sarah
right.
Shookman, our economics contributor here on What's New.
I know.
Happy to help.
Thanks so much. That was awesome. We do appreciate it.